Check on Meta. That stock is higher right now in overtime. Joining us now is Mark Shmulik from Bernstein. He has an outperform rating on the stock. You were very bullish on this name, Mark. I think it was your top pick, or at least one of them, coming into this print. Your reaction to what we've gotten so far?
I thought it was a very good performance for Meta, and certainly with the volatility in the market today, there was a lot of fears coming in about some of Snapchat's commentary on kind of geopolitical impact on advertising, and I think they did just fine. Certainly the bars crept up as everybody seems to like Meta on the top line, and I think they did a great job of also quieting down some of the fears of what happened last year in the third quarter with expenses running away. They kept it in check. So the guidance on both expenses and CapEx look very reasonable, very digestible. And, I think this feels like a de-risking type quarter for Meta. We'll listen to the call to kind of hear around how quarter-to-date trends are tracking on advertising, particularly, around some of that sensitivity with the geopolitical nature. But otherwise, looks pretty good.
So what's the new narrative, Mark, on Meta, Facebook, whatever you want to call it at this point? Meta is what it's named. I mean, a couple years ago, people were saying, oh, well, the model's broken. Plus they're spending too much on the metaverse, which, hey, they might be. But what's driving this narrative now? Is this a signal of the overall health of the digital ad market, along with Google's positive results in that vein, or are they really vulnerable to a strapped consumer? Or are advertisers going to have to advertise more to get to consumers who are looking to spend less?
Yeah, they may well be spending a bit too much on the metaverse. Certainly I don't think that debate's off the table. But, as far as the core advertising market, particularly the digital one, I think both Google and Meta, the two stalwarts have kind of shown stability in the space. Smaller names look like they're recovering as well. Now, obviously, the whole market's coming off of like real pressures and a real tough year as rates rose and we were no longer in the zero interest rate era. So folks actually cared about, how much they were spending to acquire customers. But we're seeing steady improvement in the market overall. We're going into a holiday season where, even if consumers are a bit more cost conscious, I think that just means, expect advertisers to spend more, in promotional activity to try to win those sales.
Mark, I just want to dig into the expense piece of this for Meta a little bit more deeply. I mean, they lowered 2023 expense outlook. Their forecast for next year is $94 to $99 billion, which is perhaps a little better than the street had anticipated. Nonetheless, with Reality Labs, they're talking about the fact that they expect those operating losses to increase year over year in 2023. Is there more room to be trimmed here, or is this really, truly longer term the vision for the company and it needs that meaningful investment?
I think they've kind of put the brakes on that business for pretty much all of this year, right? And so, there was always a view internally that once we get through the kind of the year of efficiency, we're going to need more resources because we have a lot more stuff to go build for the long term. And, I think we saw that at Connect a few weeks ago, the slate of new products coming down. It's no longer just the Quest 3 and, kind of the metaverse dream. There's a lot more taking place with the Ray-Ban, smart glasses, et cetera. And, so I think they think they're building for the long term. The AI wave certainly kind of helps maybe usher in some of that stuff a bit sooner than expected. So perhaps there's a bit of urgency there to kind of go build a bit quicker than, certainly investors may have originally liked. But, I'm okay with that spend so long as the core business continues to do what it's doing. And I think that's exactly what we've seen with this print.